All right, in this video, I'm going to show you specifically what I did with Company G to implement a differentiation strategy. So I've actually already made year 7 decisions, but I wanted to kind of show you how it works out. So as I mentioned in the earlier video, the first question you should ask is, what was your intended strategy? And of course, my intended strategy was differentiation. You need to figure out whether or not that was your actual strategy. Did you accomplish what you were trying to do? So the best place to do that for a differentiation strategy is to look at the comparative competitive efforts. So the differentiation strategy means to have the most differentiated product in the industry and to sell that product at a premium price. So I had a 5.2 star camera and sold it for $302. I had a 5-star drone and sold it for $1,400. That's in North America. You can look at each individual country if you like. I said that I did the exact same PQ or exact same selling price in every country. Your PQ obviously is going to be the same in every country. So I did the same price in every country, and the answer to my question of did I achieve my strategic position is yes. Okay, so the next question you should ask is, did I have the outcome that I want? And since Team G finished in first place, the answer to that is yes, right? If you're moving down in score, that means you did not accomplish what you intended. If you're moving up in score, then that means you accomplished what you intended. Okay, so specifically, the decisions that I made, as I mentioned in some of the intro videos, some of this stuff is more effective than others in differentiating your product. Okay, so what I did is I put more components across the board to get the most bang for my buck. In other words, what did I do? I put the right combination of my natural resources here, my raw materials, into my product. And I also sort of minimized on my camera the research and development because that's a much more mature product than the drone. Okay, so on the drone, I did a minor upgrade. I specifically increased the amount of money that I spent on the battery pack. I increased the rotors and pretty much just did the right combination. Here, I actually did not increase research and development hardly at all. It's $15 million, okay? So if you take a look at the action capture camera benchmarks, you can see where you rank relative to the industry. Company G, obviously, I'm going to be on the higher end for assembly and production benchmarks, but you also want to be on the higher end for your operating profit margins if you're running a differentiation strategy. On the drone, again, I was the most expensive product, but a large part of what I did there was research and development, doing a differentiation strategy, knowing that I was going to be putting a lot of money into building up my product for the future, and that's a product that is not necessarily mature yet, okay? So I believe I had the right combination of raw materials. Then you have to decide how you're going to sell the product, okay? So we have in year 7 for the first time exchange rate impacts. Those exchange rate impacts affect how much you actually net when you sell your product. So when you log into Globus, you'll see this information displayed. It's not going to look exactly like my information, but you'll see something similar displayed in yours. What that means is that when you sell products and you net down that sale in the United States, in North America, rather, we're going to lose 1.47% of our revenue because of exchange rate impacts. In Europe, Africa, we'll lose about 3.32%. No effect in Asia Pacific. In Latin America, we'll actually gain about 5% on the exchange rates. Okay, so we need to take that into account when we're pricing our products. So I'll just kind of throw that out there for you. Again, I want to have a premium product and sell that product at a premium price. And I believe that I did that. I want to be above average in my retailer support. I want to be above average in advertising. I want to be above average in sales promotions, above average in warranty. How do I know if I'm above average? You can take a look again at the comparative competitive efforts. I'm Team G. This will show you what my expenditures were for the various marketing variables. And as you'll see, I was above average on retailer support, above average on advertising, above average on website displays, above average in the number of sales promotions, and above average in the percentage discounts. Okay. Apparently, some of y'all did not listen to me, or else you did not receive the information appropriately about the effectiveness of a 10% discount. Please, folks, read the dadgum participants guide. Okay. On the drone, I'll just go ahead and jump there. I wanted to be above average on all of my marketing variables to justify my higher price. Obviously, the more I advertise, the more value I think that I can build. I'm above average on warranty. Got really good metrics. I'm exactly where I want to be on both of my products. Okay, so I tweaked my prices just a little bit going forward. I want to be above average on price. Again, if you see these exchange rate differences, okay, the reason for that is if you look at the net revenues, I'm keeping those net revenues pretty close to the same amount in all four of my markets. Okay. All right. Look at compensation and facilities. Because I'm running a differentiation strategy, I don't want to have the biggest facility in the world because I never expect to have the most market share in the world. So I did an expansion last year just to put in my workstations. I did not expand my factory on either side. Okay, what does that mean? I put in 20 workstations here and I put in 10 workstations here. Okay. I also put more money into my people. I'm effectively managing my capital resource when I put in workstations. I also did the robotics upgrade, which is saving me about $2 million a year in years going forward. Okay, I put lots of money into my people. I wanted to be above average in my compensation. I wanted to be above average in my training. I wanted to have above average productivity. So even though I'm spending more, I wanted to have a lower labor rate per unit. You can determine whether you have that by looking at your benchmarks. Okay, on the action capture camera benchmarks, my labor cost is $26.30, which is not the least in the industry. It's $26.30 per unit. It's not quite the least in the industry, but you do see that I have the best productivity in the industry. On the drone, you'll see that I'm, again, not the lowest in the industry, but I am the most productive workers in the industry. Okay, so manage your natural resources, your capital resources, and your human resources. Effectively, what I want to do, like with these decisions, is I want to make a decision, make an improvement in my expenditure for training per team. The question that I should ask is, if I change that from $2,500 to $2,750, what happens to my net profit? Okay, and if I did change it from $2,500 to $2,750, my net profit goes down just a little bit. Okay, so it's $76,561, $76,490. You might try going up to the next increment above that to see if it comes back up. It doesn't. So it looks like I've got my expenditure optimized at $2,500 per team. So you'll make those decisions. Again, because I'm running a differentiation strategy, I'm not expanding my factory, but rather I'm controlling demand for my product by raising the price such that I'm using my factory really, really well. I'm not going to overuse my factory, but I am managing demand by increasing my price. Okay, for corporate citizenship, because I know that a differentiation strategy is going to have all other things being equal, a differentiation strategy will have a lower image rating. I'm putting a fairly good amount of money into my corporate social responsibility initiatives. Okay, I might want to just look at this and see what happens to my profitability if I do any of these expenditures. If my profitability goes down, maybe not do it. Although the metric you really should be looking for here is what is your image rating? Okay, since my image rating is very, very high relative to the industry, I'm satisfied. Okay, on finance and cash flow, I'm going to teach you guys to manage for return on the equity. But what I did last year is I had 2 loans that were outstanding at 8.5%. I paid off both of those loans and I took out a new loan for $112,500 or $112,500,000. Okay, I did that because the interest rate on the new loan was 6.5%, and I could lower my weighted average cost of capital. This year, I'm going to pay off that 6.5% loan, and I'm going to refinance that 6.5% loan and that 7.5% loan, and I'm going to go down to 5.2%. Okay. Last year I paid a 60-cent dividend. This year I'm going to increase my dividend to 75 cents. I'm going to repurchase all of the stock that I possibly can. Okay. And I'm going to make sure that I have enough cash at the end of the year to cover my working capital needs. Okay. I want to make sure that my debt to equity ratio stays reasonable. In Globus, you're looking at no more than a 2-to-1 debt to equity ratio. So 67-33 would be about as far as you'd want to go. Your interest coverage ratio needs to be up there, double digits. Your current ratio is never going to be 2.0, or it should not be 2.0. If it is 2.0 or greater, it means that you've got way too much cash. Okay. So when I've made all of these decisions and I've shown you here, the question I want to answer is, am I improving performance year over year? My net revenues are going up by 16.7%, so that's an improvement. My net profit is projected to go up 24.9%. Okay, my ending cash, this plus 3,826 is literally $3,826,000 that is going up. Okay, so that's what I did for the differentiation strategy. Now you know exactly what I'm going to do for the differentiation strategy for year 7. So good luck making your decisions tomorrow. If you have questions, text me or call me. I'll be happy to help.